All right. And we are live once again with Exit Liquidity. I have with me Captain Rational, ready to be your tour guide through the fantastical realm that is macro in today's market. What do you got for me, Noah?
I'm calling it the sausage. The macro sausage machine is gearing up, and it's going to grind up all this financial material, and it's going to make a sausage. And that because that's what they're doing. They have all these gears and levers, and they're making a sausage for us. And at the end of the day, what do you do with the sausage? You put it in the barbecue, you make it all crispy, and it's nice and delicious. They're going to make us a delicious sausage.
That they are. That they are. And we were just discussing, we might as well just get right into it because that's what we do. Uh, I'll start with this because this is interesting stuff. So we were talking about this National Financial Conditions Index that is put out by the Federal Reserve Bank of Chicago, and we were just talking about this chart, and I was like, I don't actually know a lot about what is comprised uh, in this particular index. And so, a quick Google search later, and we found out that this thing has baked into it a bunch of interesting stuff, such as the Bank of America Merrill Lynch Home Equity ABS MBS yield spread. So ABS, that's asset backed securities. MBS is mortgage backed securities. Uh, it's also got CME Euro Dollar CBOT T Note Futures market depth. So that's interesting as well because that's like Euro Dollar shadow banking money is baked into this thing as well. It's got the E-mini S&P Futures market depth.
Dude, I literally, it keeps naming things, and I told you it was a sausage.
Yep,
Told you.
this is the sausage that we're discussing. This is like all the stuff that's baked in. Like it's very tempting to see these like various macro indicators and stuff, and I really like to dive into like what is in these things. What is the sausage? Like what are the ingredients in the sausage? I mean, you got some fennel, you got some pork, and then you got some spices. Here's some more spices that are in this particular sausage. The gold NYMEX WTI futures market depth. So like commodities market depth. So far we've hit a wide spread of things. We've hit like ABS MBS. We've hit shadow money. We've hit the S&P futures market depth. We've hit commodity market depth, and then trade weighted US dollar value index. And then you also have Bank of America 3 to 5 year AAA CMBS, which is commercial mortgage backed security OAS spread, uh, which that's talking about again kind of a spread against you know money markets. FRB commercial property price index, which again, commercial mortgages and commercial real estate are not having a good go of it at the moment for those that are not sure. So uh, there's some things that are baked into that are maybe not so tasty. Um, then you got the CME term SOFR Treasury spread, which that's basically saying like, okay, how much are you able to get in the market, like SOFR, which is like collateralized lending versus treasuries, and like how much are people willing to accept as far as a spread for that. So that's, I mean, to me that's kind of like a repo market depth measurement right there. and then you got the 1 year, 1 month CME term SOFR spread. So like this thing does really cover a lot
Everything.
of the macro landscape,
Not the
which
big
is why
stuff.
I think it's very interesting. But the thing that I was noting as well is look at the places where this particular index peaked and where it valleyed. Like March of 2020, this thing shot through the roof, right? And then when did it bottom? May
Oof.
of 21. That was the bottom for Bitcoin, by the way.
I love this
Uh,
chart.
or not the bottom, the top. Sorry, the top for Bitcoin. And then October 2022, that was the absolute pico bottom of, you
Very
know,
Pico.
yep. And here we are down here. So, I mean, just looking at this from like a macro perspective, I think, I don't know, we are sort of near uh, maybe some historical support. Not that this thing necessarily should be treated in the same
Uh-uh.
like
Can't.
technical analysis sort of way, but like it does tend to bottom in certain places somewhere in this vicinity. I think historical values are relatively I mean, cycles do cycle, and I think that the size of the cycle varies, but like I do think it's important to kind of look at where you are relative to the historical norms, and generally it seems to bottom, somewhere in this vicinity. So, I mean, we're not at the beginning of this. I think I think it's fairly safe to say that we are not at the beginning of this rally. That we are several innings deep, somewhere between 6 and 8 innings into this particular ball game.
The minus 0.56. You can't correlate this the same way as you can correlate other things. For instance, between minus 0.56 and minus zero point 0.6, things could have a remarkable rally.
Oh
What
yeah.
what the best expression of this chart is time and overall structure. It's a forward-looking indicator, and yes, it can be a very real-time indicator when things get really frothy. Because when things get really frothy, even to the upside and downside equally, sentiment is heightened and people respond quickly. So generally, I would say it's a forward-looking indicator, except when everyone's senses are looking for some shit to blow up. I, Generally, I don't think that's necessarily where we are, but
I don't think we are at a place where things are, ready to explode. Um I think, it's almost inevitable that we will break something at some point in the next couple of years, but I don't think we're there yet. I don't see anything imminently on the horizon. Um but I do think it's an interesting chart, and
uh,
it could run quite a bit further, and the price could go parabolic in that time. So I don't think I would necessarily be like selling anything based on this, but like
yeah,
it's interesting to keep an eye on, and if this thing turns up meaningfully, then you know it's I think safe to say that like we might be at that place where maybe you lock in some profits. I don't know,
you
but
should
like
always, you need a different methodology, and that's what I preach so much. The system can always blow up any time, any day. It is ready to implode. It's the nature of what debt is. If debt doesn't get repaid, it blows up, and then it cascades. So it's a managed system. So that's what warrants an entire reprogramming of how to emotionally respond to markets, and that plays into the structure of the portfolio, with especially with regard to expectations and the emotional response we need to have to the performance of the portfolio considerate of our expectations. Be ready for it to blow up and be like, oh shit, all right, it blew up. What is it supposed to do? Not blow up? The whole thing is designed to blow up. Of course it blew up. But they're going to manage the shit out of it, and it's likely going to go up until it blows up. No one
Yep.
should be surprised of any of this stuff.
No. Nope. But I mean, this is an interesting chart, and I am going to be keeping an eye on this because it does you know, it does offer some unique things as far as you know, the amount of indicators that are baked into this one.
Yeah, it's a big
So,
one.
yeah, it's good.
It's loose. Look how loose it is. Look at the system. This implies that they are massaging the shit out of the system. And then you roll over to other stuff
Yeah.
like the yen, and it's like, of course they're managing the crap out of the system. The yen looks like it's ready to tidal wave the system.
Yeah, this thing, holy crap, this thing goes back a lot further than I thought it did. This is very interesting. I didn't realize it went back this far, but
Look how
like,
controlled the system is. That screams what they're doing compared to what we had in the 70s and 80s from a financial
yep,
management standpoint.
yep. Well, and one of the things that's baked into this too is like interest rate changes, right? Um, and because it's got those various like treasury spreads and stuff like that, like the forwards of treasuries and stuff. So like changes in interest rates are going to affect that, but that explains why, you know, in the 80s you had this big thing. But like, I mean, look at the peak potential energy right here was 1974, and then it's just reminds me of that euthanasia coaster.
Right?
You know what I mean? The you know what I'm talking about? The euthanasia, just Google euthanasia coaster and you'll you'll see what I mean. It was this roller coaster that was designed to basically like kill you. And it starts with like this big loop, and then it's like a littler loop and a littler loop and a littler loop, and it's like eventually the G force becomes
Oh
so
my God.
high that you just pass out and die. And yeah, that's what this looks like. But
The-
I mean, we are getting to this place where you know, I feel like this chart kind of reminds me of the VIX, you know, which is the volatility index, but like it it has the same sort of vibe where it's like, you know, it can stay down low. It can get down low for a while. It can kind of chill down there, and then all of a sudden it's gonna pop up. And when it
yeah.
pops up, you gotta beat it back down again by just selling by buying massive amounts of volatility.
It's their
Um
whole job to manage volatility.
yeah.
That's the whole point of whatever their mandates are, like full employment and stable prices. By definition, all of that is within the realm of managing volatility.
Yes. True, true story. So, um, other macro indicators. Let's.
Rather than the DXY, hit the yen because that tells us why everything's trying to fall apart.
The yen is a very interesting chart right now. So, for those that don't know, like Japan is trying to find their way out of this long time, uh, you know, negative interest rate and zero interest rate policy combined
And
with
deflation.
massive amounts of intervention by their central bank. And you know, they're trying to get out of that because it just has not been good. And they're actually starting to see actual inflation. And so um they're starting to like talk about raising rates and stuff. And the problem with that is that Japan has massive amounts of debt, like massive amounts of government debt relative to GDP. Like it makes the US look like fiscally responsible, to be honest.
And then
And like the this
they're
is
not going to
like
be able to.
an
They're not going to.
expression
Yeah.
of people being unsure as to what's going to happen with
It's
this.
bullshit. They call them bullshit. You can't raise rates. You can't raise rates meaningfully.
Yeah, I
You
mean,
can literally
really,
calculate.
like look at this thing. It it is right up against this level. We hit it in 22, October of 22, and that's when the global syndicate of governments managed to push it down when the dollar was just destroying everyone. They managed to manipulate this thing down, and like a beach ball being held underwater, it just popped right back up again, and and it was pushed back down again, and here we are again. We are at a moment of destiny. Yeah, I mean, uh,
Right?
in general, if something hits a resistance 3 times, it
It's not
tends to
resistance.
break. It tends to break through it in short order, and
Ceiling.
so I would expect the same to happen. Which
It's symbolic. It can't. They can't let it.
because the DXY is a composite index that, again, you have to know what the stuff is made out of. And the two biggest currencies in the DXY are
Yen and euro.
yen and euro. Correct. So if the yen breaks to the well to the downside relative to the dollar, which is what it looks like is about to happen, what happens to the DXY?
Boom, boom,
DXY
boom, boom,
goes
boom.
up and away. And so, you know, maybe this is a magnet up here. Um
Euro's a little
which
less dirty than the yen.
yeah, well,
Euro's helping support this chart.
the euro's
Yeah,
got its own problems though. I
of
mean,
course.
like they I mean, just in general, the euro, their energy situation is very tenuous.
Mm.
They have, you know, because of everything going on in Russia and how dependent they were on Russian energy, um it it's not great for them, and they're losing a lot of their manufacturing competitiveness, like in Germany just in general is not doing well. And then you have the whole fact that the euro is basically, you have a bunch of countries that all have their own budgets, and they're not fiscally tied. They're
They're the
only
same
tied
country. The
it,
currency.
with a currency. So it would be like if each of the states could run deficits,
Oh my God.
and then the
Euro
United
denominated.
States, and then the United States, yeah, and they were able to denominate those deficits in dollars, and then they got to fight with each other over, like, you know, who's going to pay the bills when this all comes due. And like having a
I mean, technically
monetary,
we do. Don't we do that? I mean, every state has its municipalities and its
they have municipalities, but they are each state is required technically to balance their budget.
California.
Yeah, I mean, we'll see how long that lasts, but like it it is a thing. And so it's, I don't know. Having a monetary union without a fiscal union is an interesting experiment, and I don't expect it to go well. Like,
No.
but it's not like I think that the euro is going to die tomorrow. The 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 time frames that we're talking about here
There you
are
go.
on the order of decades, but I don't know how many decades the euro has left in it. I
Well,
somewhere between 0 and 1.
how long until Okay, this is what has been
maybe
on my
0 and
mind.
2.
When,
But
when does uh when does the nation state convex come online? And seriously, when does the United States start buying Japanese and European debt?
well, I mean, and I think that's what happened last time, right? Like
Oh, why?
I
Because it
think
makes
that's what happened
sense.
last time is that when when we were talking about like the yen chart, which oh, now I got to pull that back up again. Uh so this yen chart getting pushed down, um how would you do that? If you were a nation state and you were trying to manipulate the currency markets, how would you do that?
Massage, not manipulate.
Well, what you would do is,
Someone has to buy.
yeah, well, somebody has to buy. Actually, you would not buy treasuries.
Yeah,
Um,
buy yen.
you have to buy yen, which means selling treasuries. So Japanese government bonds, if other central banks hold, um, you know, a smattering of various other currencies and currency denominated treasuries, and so in theory, and the other thing is they don't really have to report the uh, composition of what they hold. Like you can't just look up like, hey, how many JGBs is the Fed holding right now? They kind of keep that close to the vest.
The Fed
And
is a public balance sheet. How many of those, Caitlin Long is in Custodia, and then their denial, denial, denial. She's been very astutely observing of the master accounts that the Fed has handed out.
mm-hmm,
So the Fed issues credit, monetizes a downstream commercial bank, and the commercial bank is an investment bank. It just so happens that maybe they're not, I don't think all of them were public, and maybe one's private. So maybe they have components that are not necessarily visible to everyone.
yep,
That wouldn't be so surprising. And just so happens one of these commercial banks happens to like investing in not in Europe and in Japan, and they like their debt. Come on, it's obvious. It's the only way for this system to work. Someone
yep.
has to buy the shed, and that's how you do it.
Yep, and they have reserves. They have reserves. Central banks hold reserves. It used to be it was largely gold reserves in the uh, gold standard system. They held gold reserves because that was ultimately what was backing their currency. But once we entered the fiat regime, then they started buying other various fiats and usually with our trading partners. And so it stands to reason that we would be able to, buy up a bunch of do the equivalent of buying up a bunch of yen. So if you sold a bunch of Japanese treasuries, which are called JGBs, you would then be selling a yen denominated asset and buying yen, which so
We inspect the asset side of the Fed balance sheet to high heavens. That's what everyone talks about. The liability side is not so granularly inspected.
and the
And
liability side means everything.
well, the liability side of the Fed balance sheet is dollars. Bank deposits are dollars. Bank deposits are uh, accepted as settlement worldwide. That's what they
Hmm.
created. So and liabilities on assets are leverageable. On average, I've heard historically the Fed does about 10 to 1 leverage their liabilities versus their assets. They could extend credit with unlimited leverage if they wanted to. They have an unlimited capacity to print dollars vis-a-vis these mechanisms just described. Those liabilities go on a commercial bank's balance sheet. They need to balance those liabilities with assets. What assets? Okay, these assets. Pretty simple mechanism.
Yeah, Absolutely. So I mean, they have tools in their tool bag for managing the FX market, um, and they can do it somewhat discreetly because they control what is in their reserves, and, and so
Who they accept as member banks. And there's
yep,
your plausible deniability because it's a third party entity that met all the criteria for a commercial bank account at the Fed. And there you
yeah.
go.
I mean, and China's been all up in that game. Like the state banks in China are
There you go.
constantly manipulating the exchange rates there, and doing other things like, hey, I show up today, I want dollars, and they just go, nah, we're all out of those. You can't have any today. Come back tomorrow. And
They create
like,
a bid.
what better way to reduce buy pressure on dollars than to just say no? Like it's it's very interesting. And this chart looks very similar, to be honest. Like one, two, oh,
Not there yet.
not quite there yet, but
That's all capital controls with the amount of deficit spending they're doing, and now literally the flat out commercial bank buying and the QE that has been explicitly stated that they're doing. They're but it is what it is.
yeah.
They manage it, and they're managing it with totalitarian control. They have more levers to pull. That's all it means.
And this is very interesting as well. Like this is a chart that you definitely need to keep an eye on too. This is, I mean, oil prices. Oil prices going up is not really good for the dollars. I mean, it is good for dollar strength, is what it is, and which is bad for uh, other currencies because everybody, the entire economy really is denominated in energy units when you get right down to it, and like the whole world runs on energy, and if energy goes up, the demand for that energy does not it energy is very inelastic. You need, you know, the same amount of energy roughly whether or not, you know,
It's cheaper not.
you have more money or not. Like you still need the same, roughly the same amount of oil. And so what happens is when the energy prices go up, it just displaces other things. And those things tend to be debt payments of like if you have other liabilities and stuff, it becomes harder to repay those. People are less willing to lend you money for other things when they're busy spending their money on oil. And so uh this is
I
what
think
what creates these sort of situations where you get the DXY pumping up too. It notice it's following oil. It's following in the same footsteps because at the end of the day, everybody needs that energy, and it is denominated in dollars. And so the more dollars you're spending on oil, the less dollars you're able to spend on expansion and on supporting your debt. And when people get desperate to pay off debt, what do? They sell off assets. And and so I mean, if oil prices keep on trending up like this, it's not going to be it's not going to be good for the macro situation because it's going to put more and more pressure on these uh, other currencies and outside the U.S.
down then
Um,
up. It's not going up now. The system wants to collapse. Everyone talks about. They talk about it in a different way. I prefer there is always a backdrop of the system wanting to collapse, and the only reason it's even capable of sustaining itself is the management of FX spreads, it's the management of liquidity conditions, and the capacity to roll over the debt pile. So
yep.
it's down before up always.
Flip
and
this
and what
chart.
now?
Oh, sorry. Go ahead.
Oh, look at the down in 20. So or when it went negative. Not this is the euro, but oil, and that was an uncontrolled, and then that's what they want to avoid. Where we're not at uncontrolled up, we're them managing the controllable to the best of their abilities, the downward thrust. It will be months before we see the what's fully to come with regard to them pushing the system into expansion. The system is contracting, they're controlling it, and the expansion has yet to come.
Yeah. Yeah. I mean, and that's ultimately what's happening here is that like there is like this sort of deflationary time bomb that's always kind of waiting to go off. Uh, and we have basically spent the last 2 decades
Yep.
uh, pushing it off, pushing it off. But every now and then, the bomb's about to go off.
But now every now and then it's 3 to 5 years. It's like clockwork.
Right, and so we are kind of in the ticking part where things are going up, but the clock is ticking. The clock is certainly ticking, and seeing the oil prices continuing to rise. And if you flip this chart upside down, it looks exactly like the oil chart.
Yeah.
Like,
Isn't that the story of Europe right about now? Is their energy complexity?
yep. And look at UK oil is, you know,
Jeez.
higher
They're in a
than the US oil. And so it's
horrible
it's
what's going
very,
on in UK.
yeah. I mean, the world is certainly in an interesting place right now.
Question of
And
social cohesion.
this is doing some very interesting things too. H
Yeah, it looks like it's bottoming to a degree, but bear in mind that's the daily. Give me the
Yeah.
captain time horizon.
Yeah, let's pull up something more
All right, so
captainly.
the world realizes it's shit. So they've pushed it up a little bit. We see a little bit of resistance, maybe a little bit of retrace, and then you run to either the channel or some sort of moving average to the upside. And then we continue with the cyclical collapse of shit.
Yep. And this is October 22 right here. This was, this bottomed and then it was like, all right, it's game on. Uh till now, and we got to kind of see where things are. It's almost like there's like this sort of center line that's kind of running through the middle of this thing that
Probably run a pitchfork from top to
yeah,
bottom in
yeah,
2008.
yep. But it is interesting anyway. HYG, for those that don't know, is the high yield
High
index.
grade shit.
High grade shit. LQDH is another one, another measurement of said shit. Um, so high yield debt. So an interesting there are some interesting factors going on with high yield debt as well, because there isn't a lot of public high yield debt being issued at these rates. Um, and so the stuff that is being issued is getting bid. It's a similar effect to what you're seeing in the housing market, right? Nobody wants to buy a new house right now because interest rates are too high. And so what you're seeing is just sort of an illiquid market where the people that want to get in that don't already have a house, they don't really have a choice and they just have to buy, and so they buy up whatever is available in the market. And the people that don't want to move because the interest rates are too high are keeping the inventory low. And it's the
Freezes the
exact
market.
same it's the exact same thing with high yield debt right now. Is you have these indexes that, people want exposure to high yield debt, so they buy, it's there's these ETF products that are out there that want to buy this stuff, and there's not a lot of it out there to buy because nobody wants to actually create any. Uh, and banks don't really want exposure to the stuff, and so people have been going elsewhere. They've been going into the leveraged loan market. They've been get,
ABS.
seeking out private capital to do these refinancings rather than public capital. And
That's
so,
interesting.
yeah, and so that
I
is
know where you could
why,
get 30%, some 30% yielding debt. There's plenty of it in crypto markets.
yeah, there is. Just got to get that stuff on chain, and you can tap that liquidity.
Oh, BlackRock's doing some interesting things in that regard.
That they
I
are.
mean, listen, it's just when you get that 1,000 foot captain view, it's like it's so damn obvious, dude.
Yes,
It's they just literally want new products,
and
and it reminds me.
they're putting money on chain. In
It,
fact, I'm going to have to add USDB to my little market cap stablecoin market cap thing soon, because I have no doubt that that thing is going to onboard a ton of real world assets onto the chain.
they're gonna love the 30% because in some regards, the 30% on chain has palatable risk exposure as compared to the bullshit associated with corporations and the hierarchy and the bureaucracy and the human resources and their debt load. You're talking about 30% yield with volatility. There's zero debt. It's volatile, but there's no bankruptcy. There's no the organization doesn't exist. It's a completely different equation.
Mm-hmm.
You know what all this shit reminds me of? It reminds me of Mr. Robot when what's his name in that lovely scene where they talk about Bitcoin and whatnot. He's like, we need to start. They, I don't even remember the damn chain name, but everyone knows the scene, and it's we got to rebuild the banking sector and start creating new assets. And that it's literally what's occurring. They need a flood of new assets, a flood of new product to sell to people because no one likes the shit that's out there.
Yep.
And this is all enticing new
Well, and
products.
and at the end of the day, companies like BlackRock, they don't care what market they're in as long as they're capturing a spread. They are just there to facilitate and be middlemen in whatever financial markets might exist. They're not there to take a directional bet on any particular thing. They're there to just rake in a a rake. Like they want to be able to just make a steady interest rate on their investments, and
Oh.
you know manage their risk.
So what you're saying is they don't give a shit necessarily about the principal cost, but they want to own businesses that got a steady stream of cash flow. That sounds perfect for
They
the
may
volatility
they want to
of
be a business that is like that. I don't know that they're to the point where they want to invest in the actual apps on in crypto yet. What they want to do, I think, more than anything, is participate in the stablecoin realm first. They want to be able to hold treasuries and create dollar liabilities, because that's a sweet business. Uh, because you're making right now, I mean, the impetus has never been greater. You can make 5% just doing nothing, and you don't have to pay it back to anyone. You can just, create your own dollar liabilities. What's not great about that?
that's what we've been talking about for years. Use collateral and print dollars.
Mm-hmm.
When you really understand that bank deposits are usable as payment, and so it's just so glanced over the reality of that. And Michael Howe said it really good the other day. He said, what bank deposits are a settlement currency, and then that
They're a
a
what
bank
currency?
a settlement.
A
You
settlement.
can you
Yes.
could pay with a bank
Yeah,
deposit, and
for
and and
sure.
then a bank deposit at Chase is the same value as a bank deposit at HSBC, and so on and so forth.
By
And then
mandate.
I just find this, and literally that's like a contract saying, all right, your stablecoin is trading at 80 cents on the dollar, but you redeem it at the contract level, it's worth $1. And
Yeah,
it's
well, or
just,
it's a PSM is what it is. You have a PSM between all of the banks, and you know who provides the backing for that PSM? The
yeah,
Federal Reserve. The Federal Reserve balance sheet is the backing for the PSM that guarantees that a dollar liability at Wells Fargo equals a dollar liability at Deutsche Bank equals a dollar liability at Citi. And that's what you got. And the problem is when you do that, you have pooled risk.
yeah,
If you force things to trade at par, you have now inexorably tied yourself to this other entity. And this is why I just in general like how robust the stablecoin market could be. Because you can manage that particular risk by way of liquidity depth in the LP pairs, right? So if I have a stable coin and I want to have some liquidity with BlackRock stablecoin, say, I can go, okay, I want this much exposure to BlackRock stablecoin. Let's make a liquidity pair and let's put this much in it. And now it will trade at par until it runs out of liquidity. And what will happen too is like when it runs out, that's all she wrote. And your risk is capped. And there's no need for anyone to step in and play lender of last resort in that particular market, because at the end of the day, like the holders of those stable coins are the ones taking the risk. They are the ones that are taking those risks, and so they are incentivized to responsibly consider those risks, um and to spread their risk out, and the problem with the current system is because you maintain that everything has to trade at par, you have now pooled all the risk. And so you are only as the system is only as safe as the least responsible actor that is in that pool. and
remarkable.
and then what happens is the Fed ends up having to fill the gaps, and that creates moral hazard. Now you have all these, it's like, oh, well, this thing blew up, so we need more regulations. Well, the problem is every single time you do that, you create moral hazard because you've created this rule where I'm going to bail out anybody that's following the rules. Uh, and so you are now incentivized to be at that bottom threshold of following the rules because you can make the most money at the bottom. You can be as irresponsible with your debt as possible, but still get bailed out if everything goes bad.
Because you follow the rules. You're part of the
You
good old
followed the
boys
rules.
club.
You're in the club. It's fine. But that is the definition of moral hazard. Moral hazard is incentivizing bad behavior systemically.
Yeah. Well, it's the antithesis. It's not punishing bad behavior.
Oh,
That
yeah,
yeah,
100%. And
pretty
and the thing
remarkable.
is, that is why, you know, free market people like free markets, because it requires a certain level of responsibility on the holders of capital to make intelligent decisions about it, rather than just giving it off to some third party and saying, well, the Fed's got them backed and whatever. I don't have to worry about it now. And now, you've outsourced all of that risk. And then what happens is, you have wolves in sheep's clothing guarding the hen house. And
I'm cynical as shit, dude. It's dead. The whole thing is dead. This is not a world that is admirable. This is not a world that is held to high standards. This is a perverse world that is on the decline. Moral hazard has been shot and it's gone, and it's hanging on by interventionism, by the unspoken mandate to finance social civility. And the sooner you accept that, you begin to see clearly how to navigate this world. Look at the NFCI and look at Move. They will go down because they have to go down. Because if they don't go down, that's when people are killing their neighbors for lunch. Social civility will be financed. Therefore, the currency cycle must proceed. It needs to expand. Otherwise, the debt cannot be paid. If the debt is not paid, you didn't succeed at financing social civility.
yep, that pretty well sums it up. I Yeah, I mean, it's uh it's where we're at.
Captain
Um
Cynical.
Captain Cynical is right though. It really does come down to, this is the system that's been created. They've spent decades pushing people to put their money into the system through various means possible, the creation of 401ks and
Oh my God.
getting everyone to deposit their money in banks, and like all of this stuff. They've created this entire financial world to get you to not take responsibility for your money and to get them to do it. And
Oh my
then
God.
conveniently, the chart for inequality probably matches their effectiveness uh at doing that. They've gotten you to push all of your money and all of your control into these centralized powers. And with that, that you've put it into the system that they control, but the problem is they're not in control. And so they have to manufacture this facade of control. This is control theater. And the Fed is the showrunner.
I agree. And they're not in control, but their entire business is to attempt control. And the least we can do as individuals is understand the control they try and exert and why, to finance social civility, and to what end. The end is very clear, is to maintain civilization, because if they fail, civilization decays into chaos, lawlessness, and disorder. So the government is incentivized everywhere to support them in their capacity to maintain social order. Literally, you could state it that they want to keep their job. Yeah, of course, because if they don't have their job, it's social disorder. And you have a collapse of government and it gets awkward. And we see what that is like in various African nations and other nations.
Yep.
And they don't want that. Nobody wants that.
No, indeed, they do not. So we had a question here from Athletic Concept. He said, "What charts should we follow for indicators of macro? I see you show a bunch. If you had to break it down to three main tickers for global liquidity, debt, etc., what are they?" Now, I guess one thing is I would be careful trying to boil down macro to three particular tickers, because the system is always changing, and that's part of why we have something to talk about every week or two, is because the system is constantly being manipulated and changed, and the rules for the game keep changing. And so which tickers matter can be dependent upon the moment, somewhat. However, that said, if I had to pick three, um I would say the DXY is probably on that list. The move
Broad
index.
inspection.
Yep.
Mm.
The move index would be on that list. And the third one is a little trickier. I have to think some more.
Say it. You know you want to say it. I know you want to say it. I'm
Oil?
not saying it. Come on, keep Pauly Shore and Biodome. Keep on cruising. Come on, you could find it. I know you're gonna say it.
I don't know. I don't know what you're getting at. Which one would you pick?
NFC.
Yeah, I mean, I was thinking it, but I mean,
You're
yeah,
thinking.
yeah. I mean, the NFCI is a pretty good one. The NFCI is a pretty good one. Um, this one is pretty nice, but yeah, I mean, the yield curve also, like maybe like the 2 year 10 year spread
The yield
is in
curve
it.
it tells you that the banks are fucked. Literally, the yield curve is the bank's business. You're inspecting the business of commercial banks, and commercial banks are their business is destroyed, and they've been annihilated. Their balance sheets are impaired. Their profits are completely eviscerated. That's the yield curve. But the banking system, the reason the yield curve was historically overwhelmingly significant is because the financial system was dependent on U.S. domestic commercial banks to print the currency. And why do we want to understand the printing of the currency? Because that's the currency expansion cycle. The more currency, the more activity, the more velocity, the more GDP. But now the real economy in the U.S. has been marginalized. And not only do we have a fiscal dominant regime, nation state regime, we have elevated interest rates for the first time in it was a decade and a half, close to 2 decades, and that changes the 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 structure and the mechanics of where currency is most favorable to print. And right now, the entire system is screaming the currency is most favorable to print offshore because the bankers now have interest rates. If for the last 20 years, bankers have had zero incentive, a 1/4% or less, to say, guys, I got deals, I got cash, I got loans. Who wants to borrow? And now they're sitting on
Well,
5%.
that and the other thing is like everyone wants to borrow at 0% interest rate.
Yeah,
And
but the
and I think
bankers
that but
selling a product.
yeah. 100%. But I think this is part of another reason that you've seen the inequality that you've seen is that the demand to lend money into low interest rates is quite low. But the demand to borrow money at low interest rates is impossibly high. And so what ends up happening is you just get this inner circle of self-dealing that happens. There's only so many loans to go around. The banks have to pretend like they're still in the business of borrowing and lending money. And so they would just lend money to their buddies. And that was more than enough to fill up to satiate whatever demand they had for lending. And so you get this very like, you know, unequal distribution of lending
I've
throughout the
heard it,
system. And
of
it
course.
yeah.
But
Now,
check this out. If you're at 5%, what's the difference if you're lending at 0% and 5%? If you're lending at 5%, now you got to throw in the bonuses. Now you got to throw in the kickbacks. Now you got to throw in the coffee cup holders, and extra cell phones and private jet trip to Maldives. You got to throw in the deals. All it is a change in the construct, and that is probably best expressed by the secular uh, uh, breakdown, especially the breakdown of the secular trend in the bond market. Just look at show the 10 year,
10 year is right here.
right?
So we got a comment that like your discussion, but you're too focused on the Fed's public balance sheet. Private balance sheet is in the hundreds of trillions. We agree on this. We have discussed this at length on our other streams that the Federal Reserve, I think of the Fed balance sheet as the visible spectrum of money. It is what everybody focuses on, but it is the tip of the iceberg. And what happens though is the private money creation that takes place is ultimately it eventually will get out in front of its skis, and it will have something happen. And when that happens, the Fed, because of this mandate to keep everything at par, it will have to pull that stuff out of the shadow banking system and into the visible spectrum. And that is the process by which we maintain that par, because eventually something out in the shadow realm breaks sufficiently to harm the banking system,
They got to buy it.
and they got to buy it, and they got to buy it, and
This is
we're in this
my
process.
the gentleman who understands the total amount of the structure of the system is Mike Howell. He's the only one that really says the bigger numbers, and he's spoken in the realm of $270 trillion worth of systemic liquidity or capacity to purchase the shit. And we're not talking about the total value of assets. We're talking about the balance sheet capacity to finance, to refinance, most importantly, and then uh, so how, like balance sheet. Balance sheet consists of two components, assets and liabilities, and it's always an interesting debate which is more important. Here's one very interesting point. I define assets mostly as a money, and we don't use money for settlement. We use money to print currency, and we use the currency for settlement. So when you're looking at a balance sheet, the assets are the money that print the liabilities as a currency. Just some nuances there.
Yeah, and the Treasury has been printing assets like it's their job, which are then being used to create dollar liabilities elsewhere in the world. And the irony of all of this is that yes, we have become increasingly focused on the Fed as a society. Like the Fed chairman, nobody should know their name, to be honest, if they're doing their job. Nobody should know who they are. But the problem is it's become such a focal point, but at the same time they've become increasingly irrelevant to money creation, because all they are is the janitor that has to clean up the mess that that happens when the US Treasury throws a party and it gets a little out of hand and everybody gets drunk and takes on too much risk.
And they sweep
So
the risk under the rug. I'm not too interested in the Fed. I'm interested to a degree in the interest rate regime, like the cutting of rates. I'm like, oh, what we do? The,
well,
the,
we have obfuscated rates entirely, because rates should be, in a perfect system, rates should be determined by the free market.
it's another
and
story.
and what we have done is we've gotten so far away. We have almost gotten to this place where people seem to think that like the Fed should be determining interest rates. I don't know why they're even involved. In fact, all they've done is distort the markets.
Well, so technically it's the interbank rate. So all they define is the rate in which their member banks lend and borrow from one another, and that bleeds over into the system.
Yeah, I mean, well, they have a few rates that matter. And I would argue that the main one that actually matters is the reverse repo rate,
Uh,
because all the other ones, so the other main ones, you have the reverse repo rate, which is the dollar staking, as I call it, where you can basically just put your dollars in your bank account at the Fed and get 5 point, what is it, 5.3. I got it around here somewhere. I have so many damn rates on here. 5.3. Yeah. So this is the reverse repo rate. I would argue that this is the most important. You have the IORB, which is the interest on reserve balances. So if you have excess reserves, then that's basically what you're getting for all your reserve balances as a bank. Uh, and then the other rate is the discount rate. And the discount rate uh, is the one that is basically, if I have a loan, I have an asset as a bank, and I want to be able to lend it, or I need liquidity. I can lend it to the Fed, and I can get money at this particular rate. But the problem is the discount rate just isn't a good deal. And that's why no one uses it, and that's why it has this stigma that the Fed despises, uh, because they want people to use the discount rate, uh, or the discount window, and they're always like, "Why is no one using this thing?"
Five
And
basis point spread on the reverse repo.
right, I mean, it's like what you have done is you've distorted money markets so sufficiently that it's never the best deal. That's really what it boils down to. Is you have distorted the public market or the private markets so sufficiently that the shadow banking system is always a better deal than you. So that's why no one's using your stupid discount window. And there's also the Fed funds rate, which Fed funds is pretty much, you know, irrelevant anymore. Um, it's just
It's a
another,
target. It's a reference rate.
the repo market basically replaced Fed funds. And so it's irrelevant. So in order of importance, you have the reverse repo rate, and then IORB, and then everything else.
SOFR's not really used.
SOFR,
Nicely.
I mean, SOFR is important, but they don't really set SOFR. Uh, uh, or do they? No, I don't think
I
they do.
that's your
I
that's
think
your
that's just a
department.
market. I think they manage SOFR by way of the
Futures.
the yeah, I think they manage SOFR um on the desk, like by doing market operations, but I don't think it's actually like something that,
It's
because
prescribed.
yeah, it bounces around, but SOFR is basically just the collateralized lending rate, and obviously they try to keep that in the window, right? Because you got the high end and the low end of the Fed rate, which is the low end is 5.25 and 5.5. There's like this window that they try to keep it in, and right smack dab in the middle of that,
The
well,
reference.
not quite, is the
FFR.
SOFR. SOFR.
533 for Fed funds,
Yeah, 533
and they
is
spread
the,
everything around it,
yep. But
manage everything around it, massage everything around it,
right, distort is maybe a
everything
better way.
around it.
Uh,
There you go.
Distort everything around it. But this is, this is what they try to do. And you'll notice that, like, basically ever since the reverse repo became a thing, like the volatility on the 1 month versus the RRP rate, you can basically tell when the RRP is full on this chart, because it just becomes very tight, you know. And the RRP is draining. Let's see, wait, where's that at? That ain't it. This is it. Here we
Yeah.
go. So this is just a big pool of money.
He's getting
Fewer
so
people, fewer people going for the dollar staking rewards. TVL going down.
how can we inspect how much has come out of Treasury thus far this year?
That gets complicated.
I've
Um,
looked up Treasury data, and back in like 2020, what I saw come out of Treasury was like 90 mil, and I was so confused because that's not like the stuff. The bills that get passed in Congress don't get reported as like Treasury auctions. It's part of the bill, so it's probably like a separate category. I would love to have a block of data like all the auctions, this is the amount of treasuries, broad
So
spectrum,
there
bills,
is a
bonds.
guy that I follow on Twitter who's really good with that sort of thing. He does all the modeling of like the treasury and stuff. And
Mhm.
like there's a lot of nuance and stuff in figuring out the gazintas and the gazautas of the treasury, because like he was basically trying to project like what the you know especially when we were down here and it was like we were trying to figure out the X date of when the government was going to run out of money. He was like diving deep into like all those flows, trying to figure out exactly when that was going to happen. His name's John K something, I can't remember. um but he's very good. And it's an interesting question. I mean, you can see that the balance hasn't really changed much because they've been basically managing it there. You got taxes coming in, because taxes are due in, you know, 13 days or whatever.
Treasury general account. It's just what they got to work with. That's
That
the
is what they
checking
have.
account.
That is what they have to work with. But since it stayed roughly the same, the amount of outflows would be basically the amount of money that they've spent on a daily basis. And that stuff is something that you can actually look up, I think, on the Treasury website. Uh,
Throw
but
my screen up when you get a sec.
sure thing.
So, Claude has a funny way of being very good and rational, but also psychedelic at times. So I, generally speaking, this is what I use as reference. And I had a nice conversation with it. We talk to machines nowadays, but it was very granular. And I'm curious, like folks throw around 8 and change, 9 and change, and Claude came out with 10.8. And this is what I would love to know. When these types of instruments come out of the Treasury Department, I would love to know technically where they go, and that would give us much more granular timing on a forward-looking indicator of when we could expect currency expansion to really make an impact on financial activity. I find the breakdown in the bullets quite fascinating. 3.4 trill is maturing, which is part of what the 34 trill outstanding. But what's the difference between maturation? Well, maturing means it needs to get paid off,
Yeah.
which means and then what's the net effect of maturation versus refinancing? They still need to, refinancing, does that imply the original instrument still exists? What was, mechanically,
I think it
maturation.
depends on what type of instrument it is, because there's, coupons versus like coupon payments would be part of counted in the maturing, right? Like, so like if you have a 30-year treasury and you're paying yearly for that, you still have to pay the coupon,
Mm,
right? But for shorter dated stuff that doesn't have a coupon, uh, you're just paying that when it fully matures.
mm.
So you have to kind of total all of that.
That's the 10.8. So they need to sell $10.8 trillion worth of stuff at varying duration, depending on, their balance
Right.
and their adjustments they've been making, to raise that amount of dollars so they could pay existing holders of instruments, which means 10.8 trillion worth of instruments will be exiting the Treasury Department and making its way into circulation. And we've discussed very specifically that those instruments are what the system uses as cash, and the whole purpose or structural significance of cash is to create currency, and dollars are currency. And then just factor in what kind of leverage the system loves to use to turn cash into currency. 10 to 1 seems pretty boring. System loves probably 10 to 1 to 50 to 1. So 10 to 1 on 10.8 is $108 trillion to 500 and something $1 trillion getting added to the dollar global regime
Yeah.
this year. That's
Yeah.
really simple, relatively simple sequence of events there. And I get tantalized by the scale and scope of that, understanding the mechanics of why and how that's the case, and then tack on deficit spending this year, and you're up at someone was doing just the run rate, and it was at 13.9 trill for 2024. That's $139 trillion to somewhere around $600 trillion that should flood the system.
Yeah. I mean,
Mechanics.
it is also relevant, because we've already talked about how the interest rate regime is a managed one. Uh, if the Fed does lower interest rates, it is going to have the impact of reducing the need to issue as much. But I think the part that people don't seem to grasp is, like we said earlier, the public or the private debt creation, the private uh, creation of dollar liabilities is completely dependent on the Fed, you know, interest rates to create that incentive to create those dollars. And so when I expect that when interest rates do get lowered by the Fed, the private money creation machine is going to grind to a halt.
At 3.54, 4.5%.
Well, maybe not grind to a halt, but it will retract significantly.
Was
Um,
wouldn't 0% grind it to a halt where they have no incentive to think of a
zero
banker.
0% would 0% would. I mean, I think maybe it won't grind to a halt, but it is going to be severely impacted. Like going from 5% to 3.5% is going to change an awful lot about their incentives. And I think that liquidity drying up could prove problematic for all the existing liabilities that exist. And so I do expect that you're going to see a hiccup in the system because there's a transition they're trying to make, right? When they lower interest rates, why are they doing it? They're lowering interest rates because they want to improve the amount of money. They want to make the money that is getting created
More
get it.
expensive.
They want it from the domestic system and not from the private system. They're trying to change that balance to be, because the banks aren't lending enough, and so that's problematic. Eventually that starts to hurt domestic employment and domestic it, that stuff, and lending for homes and stuff. It hurts all of that stuff that impacts everyday people in America specifically, but it harms all that stuff. But on the other hand, high interest rates allow for the global money printer to go burr. But the problem is when they lower interest rates, they're trying to change that balance, and I don't expect that will go off without a hitch. That's
This
all
what
I'm
has
saying.
me. This is what has me so uh, uh, excited. Understanding time. And what you're very much highlighting is a time period between 2020 and 2024, because we were at basically zero in 2020.
Mm-hmm.
And yes, they want to adjust the incentive to create currency towards the domestic side by lowering from where we are. It de-impairs commercial bank balance sheets, creates liquidity. Now the banks have a capacity to lend, and that's that whole mechanism. And we're on the same page regarding higher interest rates favoring international money printing because now Now there's an actual incentive to lend money because the banks could actually make money. So oh, you want 2 to 1? All right. Now we'll give you 3 to 1. I know it's a little expensive, but they really want to get that deal, so they'll give you 5 to 1 because they have, if their bank balance sheet internationally has capacity, take it. It's a deposit in our account. You're going to spend it, and it's going to circulate in the system, and the banks make money. That's all the reason in the world they do this. So I'm not too interested in 2020 to 2024. I'm mostly interested in 2000 to 2024, and this is the first time in decade decade time horizons where internationally there's, let's say they settle on 4.5, and that would be a lot of cuts, probably more than the market's pricing in 4.5%, and there's a flood of money into the system this year. So it's literally the first time in decades where we're primed for banks internationally to have the capacity and the incentive to structurally, like a structural expansion of the global currency regime. They've been operating in the hundreds of trillions of dollars. Where's this all heading? You think we're not going to head into the 2, 3, 4, 5 quadrillion, 10 quadrillion order of magnitude? It's where the whole debt construct is heading. So I think that's what the bond market indicates, a secular, and I think we need to go beyond what people think is, you know, uh, tame, and get into the exotic potentialities, a structural expansion. The bond market literally just flipped for the first time since '81.
Flipped how?
The
Oh,
secular
oh,
trend.
oh, right, right, right. Yes, 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 yes. Interest rates go down versus interest rates go up. Yep. So just want to also point out, because I had this thought. This is the RRP, right? There's $441 billion in here chilling. When the Fed lowers interest rates, this thing, if it's not already empty, is going to fucking zero.
And then they got to buy uh, off the market.
uh exactly, exactly. And the thing is, once this thing goes to zero, your margin for error goes to zero. And I think that's why the Fed has been so hesitant to let this thing go to zero. You can kind of see that the trajectory on this thing has slowed down of late, and I think some of that is maybe tax related because you've got liquidity getting sucked out for taxes, and so if you're sucking liquidity out for taxes, you know, well, actually, no, that doesn't really explain it either. So, I mean, this thing has not been going down as much late, and I do think that the Fed wants to keep this as a buffer because they don't know where the lowest comfortable level of reserves is, and they're not about to start betting on where that might be. This is the level of reserves, but like, we'll see. It's still
Well, they
trending
saw the
up.
comfortable 3.066 was the comfortable level of reserves,
Yes,
and things
we
started
found it.
blowing up. And we found interest rates at a comfortable interest rate where we literally blew up England.
Yep, true story. But the thing is, right now they're trying to be very hands off. They're trying to pretend like they're not managing the system, and so I know nobody believes it in the cynical and rational department, but like it is what they're trying to put out there is that, oh yeah, we're just letting the market do its thing until it doesn't do the thing we like. So
To take it to a step further. It is it is managed every second of every day, and they are constantly looking for new levers and capacity to smooth out the deflation and inflationary pressures, and they're obviously thinking about the social disorder that comes about when when the disparity, when asset prices go 10x on the money, and then the wealthy have 99.99%, not just 99%. So that's exactly what the WEF is thinking about. And how do you manage social order when the wealthy own not just everything, but everything squared?
Yeah.
And look, they literally said, "Oh, nothing, be happy." I was literally this year when everyone's renting. It's literally this year, and that's what they're talking about. So just, it's not even.
And the irony is all those people that were buying up like Blackstone and a lot of those firms that were trying to buy up all the real estate so that they could be landlords and rent out to all of the people that own nothing. Like they all bought the top and they
Yeah, but they
are
don't
going
care.
to
The
capitulate.
depends if they have a, because they don't necessarily care. And that's something that I appreciate with the way I manage my capital. They don't care about the principal unless there's debt, unless there's an interest rate tied to it. But if it's just capital, what they care about is the property, and the property being productive. That's all that matters.
Yeah.
The balance there, the value of the principal, the value of the property will fluctuate over time, and it doesn't really matter if it's like hold to maturity.
Yeah.
I mean,
Yeah.
there is no maturity on property, and all it does is produce cash flow from now until the end of time.
Yeah.
And
Well,
in a world,
in a world where everyone is continually making new financial assets uh, that may or may not go up depending on inflows into that particular asset class. Owning something that has a productive capacity puts you ahead of the curve because you don't ever have to sell it because you don't care.
and if look at what you could do at the commercial banking level is, I could, if Chase needs cash, Chase can loan HSBC cash, and then HSBC could loan that cash back to Chase, and now both of them just swapped assets and liabilities, and they manifested cash out of thin air. The commercial banking system has a capacity to print unlimited cash mechanically, with double entry accounting, and they could they buy these things, so they don't care about the principal value. They just care about cash flow.
Indeed.
Just I get a kick out of simplifying the crap out of things, and just and from a reductionist perspective.
Yeah. I mean,
And
they're not much like the 21 million hard cap on Bitcoin. They aren't making new real estate. Um,
they do to a degree.
I
It's
mean, I
limited
guess
supply,
you can build, the towers higher and whatever, but
and
like
it will expand. And
the land itself is finite. Um, Now that being said, uh, I'm not one that believes that the 21 million hard cap will remain forever, but
if existentiality on the miners, existentiality, and you take things to an extreme. I'm an extremist with regard to understanding what happens at the edge cases. If their existentiality is on the line, they will vote to survive.
they will. They will vote to survive. And that being said, I didn't really plan on going down this road just now, but I do think there are two paths available to them um, when it comes to Bitcoin and the 21 million hard cap. One is you continue with this. We are going to make simple money that cannot be touched. That d- is very uh, simple and doesn't have any complexity to it. That is a feature of Bitcoin. It's been a feature of Bitcoin since inception, and it is why Ethereum became a thing because Ethereum thought that it could be more. That programmable money could be more than that. I think that if Bitcoin decided to be a little more expressive code wise, put in more useful opcodes that allow for things like layer twos, layer two scaling solutions to exist, uh, it would create a boom in the transaction fees, which would then secure the network.
That's what
And
ordinals did.
I mean,
I
ordinals definitely helped. Ordinals definitely helped, but it was sort of a shot in the arm. I don't know that it has the long term duration to keep transaction fees high enough to maintain the security budget, to keep Bitcoin safe long term with issuance about to be cut in half again in little less than 3 weeks. So, you
we'll
know,
see. I think hard NFTs is an interesting concept, not from what people think of NFTs, but NFTs are basically uh, metadata storage, immutable, not immutable, mutable metadata storage capsules, something that's portable and transferable, so on and so forth. So storing that in Bitcoin has, and it's a product. And you could compare the relative interest in that product to NFTs on mainnet versus NFTs on wherever the hell you want to look. Um, and in the end, we have to see what the market wants from a product. So there is certainly uncertainty or a degree of uncertainty associated with even where Bitcoin's heading. And I don't think anything changes in the short term, but it comes down to
no, I don't either.
incentives. Everything is incentives. Every action every human being takes is always an incentive at the root of behavior. Two, existentiality. It means everything.
Indeed. It incentives show me the incentives and I will show you the future.
So,
It that's how it works. And that is, I mean, that is what we do. We try to figure out where the incentives are pointing. And and that is the only way to play the macro game. Understand the incentives. Understand the system as it is constructed, not as you wish it to be. Uh and that to me is where I think the gold bugs tend to get it wrong, is they're imagining the system as they want it to be, and they're looking at what it is and they're saying, look at how different this is than what it should be. Don't worry about what it should be, worry about what it is, because that will tell you the incentives. There this
system wants
this
collateral. The
this
system wants leverage.
fantastical idea that the world is just going to somehow revert back to barter with rocks
Ah,
is just
It's,
silly. And you
it's
see this
credit.
in the Bitcoin maxis too, that like somehow the world is going to you know, the dollar's going to blow up, and then everybody's just going to barter their bitcoins back and forth, and it will be a libertarian paradise. uh
There'll
and
be no progress and innovation, no building, no entrepreneurs. There's no it is there's no entrepreneur without credit. There's credit even if gives someone's investing Bitcoin, it's a degree of credit involved. There's a contract,
mhm,
there's risk. How do you manage those things? How do you manage that what is owed? That is the concept of credit. So an investment
yep,
is a degree of credit. You're
mhm.
lending this money to someone for a potential return. So
the the
Bitcoin,
thing the thing that I find so silly though about that stance with Bitcoin, right, is that like these same people will talk about how they, you don't sell Bitcoin, you just borrow against it. Where do I do that? I have to go to a centralized entity to do that because your code does not support really doing that on chain. And so, how have you fixed anything? You
they
have
fix
not really.
money.
I
I
mean,
like the argument of fixing money. I definitely subscribe to fixing money, but people don't understand money because you know how I define money.
right. Well, and
Bonds are
and
money.
until Bitcoin, until I can use sats to pay my mortgage, that's not what I need. I need dollars. And
Nobody in their right mind uses sats to pay a mortgage. What you want to do is borrow against it. It's exactly what they say. But what you need is those facilities. You
right.
need to turn the money
You
into
need,
currency.
but those facilities need to, if you want to fix those facilities, you need the code that is expressive enough that you can do that in a decentralized manner. Otherwise, you're just going to give all your Bitcoin to BlockFi or something stupid, and it's going to blow up.
Anywho, but yeah, money prints currency. Currency is used for settlement. Money is optimally appreciating, and this is literally what the world tells us since 81, is that the world worked well in an appreciating money regime because you could continuously expand the system, and the solution is this is how you fix money is Bitcoin. How do you fix economics is you unfuck credit, is you don't and immutably do it where the system cannot print excessive money. It needs to be controlled to protect the infrastructure.
Yep.
Favor the financier over the debtor, because that's the antithesis of what the world. Because then you can't extend the credit, and that's how you fix credit. That's how you fix financials.
Yeah.
Anywho,
I think this is a good place to call it. But
very nice.
it's been another wonderful one. I think we looked at some interesting charts, saw the world as it is, not as we wish it to be.
I
But
appreciate that.
till next time, don't be exit liquidity.
Stay rational, folks. See
And
you soon.